Hi everybody, Thomas at Rebel Income. Some of the big questions to start 2024 have been centered around inflation and when the Fed is going to start cutting interest rates. Now, they started that speculation last year by publicly suggesting as many as 3 rate cuts could be on deck by the end of 2024. That, of course, prompted a lot of analysts and investors to predict between 4 and 6 rate cuts, depending on who you're listening to. Despite those rosy predictions, there are also plenty of economic indicators and opinions that don't support the idea that rates should start going down. Some analysts, for example, are predicting that this week's major economic reports, the Consumer Price Index and the Producer Price Index, will reflect some of the data seen last month that suggested that consumer spending was much stronger than anticipated. That could prompt the Fed not only to continue to keep rates where they have been since July of last year, but also to potentially put a new rate increase on the table. That creates a lot of uncertainty. And with that uncertainty in mind, let's talk about Nike, the stock that I'm spotlighting today. Historically, this is a company that has been heavily dependent on their retail partners for sales. Over the last several years, though, they've been working on transforming their business into more of a direct consumer operation, especially when it comes to online and the ever more important digital space. While they've managed to grow their direct consumer business to about 44% of their total revenues, the fact remains that they are heavily dependent still on their wholesale channel. Consumer spending tends to lag the ebb and flow of interest rates. That's why the market's paying a lot of attention to the Fed's effort to achieve a quote-unquote soft landing, meaning that they successfully contain inflation without pushing the economy headlong into a new recession. For companies like Nike, who live and die with the consumer, that creates a lot of uncertainty. Let's see what that's meant for the stock in the last year. Nike is a stock that's seen quite a bit of volatility and movement from high to low over the course of the last 12 months. At the most recent earnings report, Nike peaked at about $122.50 and then plummeted overnight to a level below $110 per share. That put an end to an impressive upward trend running from October through December and is now even further down to its current level at around 103. It hit a bottom last week at around $102 per share, has come up a little bit from that point. That puts support for the stock right here at $102, but also very near to resistance, which is where the stock is starting to approach now, with its current price just a little bit below $104. That means that right now the stock is at a little bit of a crossroads. Certainly the pattern looks pretty bearish and alarming if you're a bullish investor. At the same time, if the stock can push above $104, that might represent an interesting counter trend opportunity to buy into the stock and take advantage of a short-term move upward. Now, as a value investor, the drop is also interesting simply because it starts to raise the question of whether or not the stock's price could represent a useful value now based on the overall book of business that the company is operating with. And the current drop might represent a nice opportunity to take advantage of. So let's dive into the fundamentals and see what those tell us. While free cash flow has been relatively modest considering the size of company that Nike is, it has also increased pretty nicely throughout the course of the last year. 12 months ago, this number was a little under $1.8 billion. And increased as of the last earnings report to a little under $4.5 billion. Despite that increase, that did mark a drop from the quarter prior when free cash flow was about $4.8 billion. It's a little bit of a mixed bag, but overall, the pattern over the last year is pretty encouraging. Company's balance sheet also shows quite a bit of strength and is very healthy, despite the fact that it has declined from about $10.8 billion in cash and liquid assets a year ago to $9.9 billion in the last quarter. When you compare cash to the quarter prior, however, we see an increase of a little over $1.2 billion. 2 quarters ago, cash and liquid assets were a little under $8.8 billion. So that's a very healthy and measurable increase that is useful to see. Long-term debt has been relatively consistent throughout the last 12 months at $8.9 billion and has not really changed materially over that period. Company's balance sheet then indicates very clearly that they could liquidate all of their long-term debt with available cash if they chose to do so. Supporting the company's strong balance sheet is their operating profile, which I like to measure using net income versus revenues over time. In the last 12 months, net income was 10.28% of revenues and increased in the last quarter to 11.79%. That's a modest increase, but it is an increase in the face of generally inflationary conditions that have caused a lot of companies to struggle over the past 12 months, especially in the retail space. Nike is a stock that's paid a dividend for quite some time. The fact that they pay a dividend is more interesting than the size of the dividend. At the stock's current price, it's just a little under 1.5%. More interesting as a value investor to me, however, right now is the fact that my fair value analysis, which combines price to book with price to cash flow analysis, puts the stock's fair value target at a little over $166 per share, with a discount price at $133 per share, and the stock sitting just a little bit below $104 per share right now. That means that the overall long-term opportunity in Nike is a little over 60%. That's very attractive and very interesting. So if you're going to be looking at Nike as a potential new long-term buying opportunity and you want to try to factor in some of the stock's current momentum, let's consider what taking a new position would look like in terms of near-term reward to risk. I previously mentioned that the stock has current support right at around $102 per share, with immediate resistance right above the stock's current price at about $104, based on a lot of pivot activity seen in the summer of 2023 and extending all the way over to the current price. Now, if the stock can push above $104, it looks like it should be able to rally up to next resistance right around the 200-day moving average, which is at about $112 per share. If, on the other hand, the stock reverses, it breaks down below $102, it looks like next support is likely to be quite a bit lower based on a pivot low seen in late October and some pivot activity in mid-August at around 98. That means in terms of overall risk to reward for Nike, if we can see a push above $104, the net potential upside is about $8 per share against about $2 from $104 down to $102 to support. That means that the stock's reward to risk ratio right now is about 4-to-1, which is very attractive if you're looking for a near-term trade. That also lends some weight to the idea that the stock could be worth buying right now with a little bit of positive momentum on its side, even if you're thinking about trying to take advantage of the overall value opportunity. Altogether, that means that Nike right now represents a pretty terrific buy. Thanks everybody. I hope you found this video useful as always. If you like my content, please go ahead and subscribe to my channel by clicking on this link here. You can also learn more about my Rebel Income system by checking out this video. If you'd like to subscribe to my Rebel Income reports or trading alerts, you can do that at my Patreon page. You'll find the link in the description of this video. Thanks again, everybody. Talk to you again soon.